Life insurance is one of the most misunderstood products in personal finance, mostly because it's sold on commission, and whole life policies pay agents commissions that can run 50 to 100% of your first-year premium. That's not a conspiracy, it's just public information about how the products are structured, and it explains why whole life gets pushed so hard. Today we're comparing term and whole life using real numbers, so you can see exactly where the $500,000 mistake comes from. Term life insurance is simple. You pay a fixed premium for a fixed period, 10, 20, or 30 years, and if you pass away during that term, your beneficiaries get the death benefit. If the term ends and you're still alive, the policy simply ends, and you get nothing back. That get nothing back part is exactly what whole life salespeople use to make term sound like a waste of money. Whole life insurance, on the other hand, covers you for your entire life and includes a cash value component that grows over time, tax-deferred, which you can borrow against. It sounds better on paper, permanent coverage plus a savings account, but the cost difference is enormous. For that same healthy 35-year-old, a 20-year term policy for $500,000 runs about $58 a month. A whole life policy with the same death benefit runs about $480 a month. That's roughly $8,300 more per year. Here's the strategy that consistently wins for most people. Take that $422 monthly difference and invest it in a low-cost index fund instead of a whole life policy. At a conservative 7% average annual return over 30 years, investing $422 a month grows to approximately $478,000. Some of that whole life cash value growth is also tax-deferred, but it typically grows at a much lower effective rate, often in the 2 to 4% range in the early decades, once you account for fees and the cost of insurance embedded in the policy, and it can take 10 to 15 years before the cash value even exceeds the premiums you've paid in. Meanwhile, your term policy plus your own invested difference gives you both protection during the years you actually need it, when you have young kids, a mortgage, dependents, and a growing asset you fully control, with no surrender charges and no need to ask an insurance company's permission to access your own money. To be fair, whole life isn't a scam. It's a mistake in the wrong context, and useful in a narrow one. It can make sense for high net worth individuals doing estate planning to cover estate taxes, for someone with a special needs dependent who needs guaranteed lifetime coverage, or in certain business succession planning situations. But for the vast majority of people, someone in their 20s, 30s, or 40s, who needs coverage to protect their family's income while their kids grow up and their mortgage gets paid down, term life covers the actual risk for a fraction of the cost. And by the time the term ends, ideally you've built enough assets that you're self-insured and don't need coverage anymore. If you don't currently have life insurance, or you're not sure whether your current policy is the right fit, the easiest first step is comparing term life quotes from multiple insurers at once, instead of talking to a single agent who's incentivized to sell you the higher commission product. I've linked a comparison tool in the description, similar to Policy Genius, that lets you see quotes from several A-rated insurers side by side in a few minutes, based on your age, health, and coverage amount, with no obligation to buy. Recap. Term life insurance is cheaper because it only covers a set period and pays out only if you pass away during that window.
Whole life is 5 to 10 times more expensive because it bundles in a savings component with mediocre returns and high fees. For most people with dependents, buying term and investing the difference builds significantly more wealth over time. In our example, over $500,000 more. If today's video challenged something you thought you knew about insurance, subscribe, because Friday we're covering exactly how much car insurance you actually need in 2026. And most people are either dramatically overinsured or dangerously underinsured. Insurance comparison link is in the description. This video contains affiliate links, and I may earn a commission at no extra cost to you. This is not financial advice, for educational purposes only.